Hey everyone, this is Mike Minter with Financial Synergies. Hope you guys are doing well. I put together this video today to discuss what the heck is going on with your bonds. And this video is primarily directed towards our clients and your bond portfolio. Although if you're not a client, you just want to follow along and learn some stuff about bonds, that's totally fine too. I have no formal script here, guys. I've got some analysis and some charts I wanted to share with you guys, and hopefully a little bit of clarity on what exactly is going on in the bond world. I know you guys are probably not super thrilled with your bond allocation right now. Nobody is. It's kind of this weird hangover period from last year, which was basically the worst year on record for fixed income. And although not nearly as bad this year, it's still been this kind of ho-hum place to be and not particularly fun. And we get it. I completely understand. I know there's been questions and concerns around bonds for quite some time, and just wanted to hopefully address that and try to allay some fears and concerns. So let's get right into it. Again, I really have nothing formal written down here. I'm just trying to follow these slides and give you some insight into our thinking. So bonds and rates are driving the markets. So this has been the story this year. Bonds and rates are basically driving everything. Rates are an extremely powerful variable in the markets and always have been. But over the last 18 months to 2 years, they have been the driving factor, really. So rates rising after 4 decades of decline. Treasury yields now at 16-year highs. Inverted yield curve. We'll talk more about that. Bond prices down, the inverse relationship, right? So as interest rates move up or down, bond prices move in the inverse direction. So as rates are going up, existing bond prices are down, which is at the end of the day, that is the reason for the depressed bond portfolio. Mortgage auto loan rates not seen in decades. It's a big deal for the economy. Inflation at multi-decade highs. I don't think any of this is a surprise, but we'll talk more about it. Fed aggressively raising rates to fight inflation. So again, I don't think any of this is a surprise. I just wanted to give a little color around how we got here and why. So if you look at historical rates, we went through a 40-year period, essentially, of declining rates. This was kind of a panacea for capital appreciation in bonds because as rates, now granted, in this period here, get my little laser pointer out. In this period, it's not as if there were never any periods of rising rates. You can see that there were many periods of actually, rates ticking back up from their recent lows. But secularly, over a long period of time, rates were in a decline for essentially 40 years. So what does that do? Rates are coming down, bond prices are going up. You're experiencing capital appreciation in the bonds, and so it's this kind of great period. Now, granted, rates are coming down, so the bonds are losing a key component that they've always had, which is income. There was no yield on bonds, so it's essentially it got turned upside down, and so capital appreciation kind of became the name of the game, particularly as we got into the 2000s and the latter part. Rates, as you know, were essentially gone, just none to be had, almost negative in some cases. So that is now reversed hard. So now you can see the 10-year Treasury and 2-year Treasury, and actually the 2-year is yielding more than the 10-year, which again is topsy-turvy. That's not normal, and we'll talk more about that. So 40 years of declining rates and current rates. So this just follows through with what we were talking about. You're now seeing this reversal. We had the COVID-19 pandemic, right? Just things got to all-time lows, and now you've seen a real bounce off that, and actual inflation coming into the picture after basically 40 years. In my entire career, inflation has almost been a non-issue. It's always there, but it's essentially been a very minor variable, and that's changed. Inverted yield curve. So we talk a lot about this. I write a lot about this. So this is kind of in a nutshell, that's all you need to know about the bond market. This is not normal. So you do not typically have rates on the shorter end of the maturity spectrum earning more than the long dated bonds, the longer maturity bonds. It even just doesn't make, and intuitively doesn't make any sense. You're taking on much more risk to buy a 30-year bond or a 20-year bond or what have you. There's much more interest rate risk, duration risk. Duration is essentially the measure of interest rate sensitivity. To invest in these longer dated bonds, you should get paid more to hold those bonds, and right now you're not. That's a counter to what a healthy yield curve should look like. So you can see we're looking at data points here from the latest, which is basically yesterday, last quarter, and then 1 year ago. And so things, at least a year ago, still inverted, but at least on the very front end of the curve, it was still sloping up. But since then, it's just done a complete inversion. And so this is the environment we find ourselves in now. So that's indicative of kind of a sick fixed income market. And that's a function of the Fed aggressively raising interest rates, and they affect primarily the short end of the curve, the front end of the curve. And so with these increases that the Fed is incrementally doing pretty aggressively, it has caused this kind of artificially to get turned on its head. And so it's a very weird environment. Just know too that is not normal, and it can't stay that way and will not stay that way. But that's where we are right now. And so real quick, this would be in a normal environment, a healthy environment, you would see more of a slope like this. So shorter maturities get paid a lot less in yield, and as you go out to maturity, your rates would increase. That would be considered a very healthy yield curve, and we will see that again. There's no question. It's just a matter of when. So mortgage rates, talked about this, highest in decades, close to 8% now. This is a little bit dated. It's from about a month ago. Pretty much 8%. That affects the economy dramatically because, let's face it, housing, home prices, home sales, all those things, a pretty big deal in the economy. So not necessarily a good thing, but again, looking back historically, where we've been is not normal. We've just gotten used to this 20, 30 year period where rates have been practically nothing for mortgage. I mean, people were locking in mortgage rates at 2.5% at one point, even lower. So we're kind of getting back to a more normal level. That's going to be a little painful for a while until we can digest that this is maybe a little bit more normal. Now, I don't think that these rates going up are going to continue at all. I think we're in a shock to the system right now, and so things have acted rather dramatically and will stabilize. So why even hang on to bonds? So it's a valid question. It's very hard in a little short span when you see things like a 1 year, 2 year CD or a money market fund outperforming a bond. You say, man, why am I even hanging on to these things? I get it. Right now, as it stands, it does make more sense. I mean, you would be better off right now in this moment to have cash as opposed to certain durations of bonds and depending on what your objective is, simply because of the higher yield on the money market funds. You may be able to get 5% in a money market fund or thereabouts in a CD. And I get it. It's hard to be attracted to bonds in this environment, knowing that you could just get that close to that or better on a CD or a money market. So I'm in full understanding of that. But what we have to understand too is bonds is more of a long-term strategic allocation, and you should expect to be compensated for the added risk you're taking in bonds, which is exactly what we expect. So we expect to make more money in bonds, period. Otherwise, why invest in bonds? But there are other reasons too, right? So the purpose of bonds in a portfolio Income. Income is actually coming back now. That has almost been non-existent for the last 10, 15 years. Capital appreciation, almost to a lesser extent. But over that 40-year period we looked at, capital appreciation almost became paramount. I mean, that's what it was all about in bonds. And that is really not historically been the purpose of bonds. Bonds have been primarily for income. So stability, long-term ballast against stock market volatility. I realize the irony in saying that, considering bonds have not been that super ballast over the last 18 months. They did not do what bonds normally do in 2022. They just didn't. They went down along with stocks. Now, they went down less than stocks. So the reality is having them in your portfolio last year as compared to all stocks still helped, to a much lesser extent than we've seen historically, but it still was there. They lost money, but lost less. I understand that nobody's going to write home about that, but that is the case. So bonds, as we talked about, are a long-term strategic allocation to a diversified portfolio. The cash is not. Cash is an allocation, but it's not. It's more for, let's face it, it's more for short-term expenses, emergency funds, known expenses that may happen in a year or two, like purchasing a house. Absolutely. Everybody needs cash. I get it. And it's nice that we're earning more money on our cash. That's a good thing. And we're aggressively allocating excess cash to money market funds that are, in that 5% range. But the reality is bonds have to be looked at in more of a long-term basis. And there are reasons that we hold them, and there are reasons to be actually optimistic about bonds going forward. And we will talk more about that. So let's move on to the next one. So FSWA. So these are our bond funds. So this is not all encompassing. I realize that there are some funds that may be utilized that are maybe not showing up in this list. I tried to add most of the primaries in here due to space. But as you can see, these are our taxable bonds, and these are our essentially tax-free municipal bonds. As you can see, again, it's been a pretty abysmal period for bonds. I completely understand that. We all do. It's unlike anything that most people have seen in fixed income in their lifetime. So the pain is real. It's palpable. I completely understand. But I did want to point out that the lackadaisical performance in fixed income, particularly in our portfolios, it's not due to some dramatic underperformance of our bond funds. They've actually done very well, relatively speaking. I know that doesn't make you feel any better because returns are what they are and you feel the pain of losing money. But I did want to point out that, again, we're actually happy with our bond funds. It's not as if they haven't performed up to expectations. Now, granted, we are monitoring a couple, and changes will be made if necessary. We are always doing that, rest assured. But if you go down the list here, here's your basically your bond market, Bloomberg Ag for this year, and it's down about 2%, let's call it. Across the board, all of our taxable bonds have actually outperformed the broad market bond universe. That's good. It's a very short-term time frame. It doesn't mean a whole lot, but it's not as if we're dramatically underperforming the bond market. This just has not been the case. You go out a year and you're basically seeing the same thing. The bond market's essentially flat, and we've got our bond funds are up until these top two are outperforming that. So again, a very short period of time. I get it, but just to let you know, we're monitoring all this, of course, and it's not as if we've got some dramatic underperformance in our managers. They're doing a good job relative to the objectives of their fund. The case with municipal bonds as well. Not as much outperformance here. You're still seeing that on the majority of these funds, but some have fallen off. Again, year to date, not much to to write home about or hang your hat on. I get it, but it's just indicative of where we are. As you go out a little bit longer on the 1 year, you're seeing greater outperformance from our funds, which is great. It's exactly what we're looking for. So just to give you a little window into that. So this brings us to kind of the crux of this. It's not time to abandon bonds, but if you have bonds in your portfolio, there's a strategic reason you have them there. Abandoning them now based on where we are at this moment, it would be a very short-term move based on very short-term events that I believe will pass. If you look to history, you are almost certain to get through these environments. They are cycles. They can be very painful, not unlike a stock cycle. It'd be easy in a stock in a year where stocks are down, like last year, or name the year where stocks are down, to say, I want to abandon stocks, I'm done. I'd be better off in cash right now. Sure, there are periods like that, just like there are periods where you're better off in cash than bonds right now. But we don't know when, we can't time these things. We don't know when that's going to turn. So for the very reason we invest in stocks is the same reason we invest in bonds. We know that over a long period of time, stocks are going to make way more money than cash. And bonds are going to make more money than cash over a long period of time, particularly as you get out on the duration scale a little bit. So it's the same logic. It's just a weird environment we're in right now. So our managers are, and we have conversations with them ongoing, are finding great value on discounted bonds, and they're locking in attractive rates. So let's talk about this for a minute. So think about the inner workings of a bond fund. There are 1,000 bonds in there, sometimes more, thousands of bonds. That within this portfolio of bonds many are maturing on a constant basis. When the bond matures, the principal and interest, it's guaranteed. So it's coming back in. The proceeds are coming back in as those are maturing, and the cash is essentially flowing in. So these managers then have to look for other opportunities. So guess what's happening? Even though the prices on these existing bonds have been depressed because of interest rates going up, when they mature, it still matures with your principal value. Even if all along the way prices are moving up and down, you still are getting your principal and your allotted coupon, your interest on that bond in the proceeds. It's coming back, regardless of what it did along the way. And so those proceeds flow in, and the managers are looking for their next bonds. Well, what's happening now? The new issued bonds are earning way higher yields, and they're getting them at great value. And so they're reinvesting the proceeds into these newer, much higher yielding bonds. So what you're going to end up with is a much better, healthier bond portfolio over time. It's just very painful getting there. But it is going to pay off for these guys and us and you if we let the cycle play out. So rates will decline and normalize. There's not a question of if rates will decline. It's only when, because it's like life. It's like the weather. It's going to go up and down. Rates go up, but they will come down. And we may start seeing that, who knows, sooner rather than later. Nobody can predict that for sure, but we'll talk more about that. Seeking shelter in cash may seem safe, but it comes with hidden risks. So if you take all of your money out of bonds, and I'm not saying anybody's suggesting that, but and you put it into cash, and then rates start to come down, and then now you've gotten out of these bonds that are going to participate in capital appreciation from a decreasing rate environment because the prices go up, inverse relationship. And by the way, these newer bonds that have been issued have much higher yields. You've got a kind of a double whammy to the positive there. You've got better yielding bonds, and you've got a capital appreciation. If you've gotten on the sidelines just sitting in cash or locked up in a CD, 1 year CD or 2 year CD, That cash is now got to be dealt with, right? Because what's going to happen as rates start coming down is those CDs are not going to be, the new CDs are not going to pay near as much in yield. They just won't. And your money market fund yield will come down as well. That's just the function of the money environment, the rate environment. So you have what's called reinvestment risk, and that's down here. Consider the reinvestment risk. So now you've got to find a place to reinvest that cash. The problem is the rates you were getting may not be there now because rates have come down. And all the while, the bond universe, the bonds are actually doing quite well because rates are coming down, prices are going up on those bonds. So the bonds that these managers have bought are actually doing quite well. So that's a real risk. It's just a function of the market's big reinvestment risk. Heavy allocation of cash could result in missing out on capital. We just talked about that. So as rates come down, that's a real thing. You only have to look to history to see the pretty big capital appreciation opportunities. So these are just some of the reasons. There's not all the reasons, but it's a reason we have held bonds and have always held bonds for clients where it makes sense to have an allocation to bonds. I know how frustrating it's been, but there is still a strong case for fixed income. Cash bond comparisons, real quick, just again reinforcing that it's easy to look at money market rates and super short-term bonds right now and say, man, they're doing so much better than these longer duration bonds. Why even hold these things? Well, because things are flipped on their head right now. All you had to do was look at the yield curve to know that it's a sickly market right now. It's turned upside down. And you should expect higher returns for your longer duration bonds. There's no other reason to hold them. And we absolutely do. Mid-duration historically outpaces inflation, a big one. Cash does not. And you should be and will be compensated for the added risk of holding a little bit longer duration bonds. That's just a function of the market. It's the same reason you would expect to make more in stocks than you would in bonds. There's greater risk. You should be rewarded for that. And historically, that has played out. So this is just a little synopsis. For example, we have our U.S. T-bills, 1 to 3 months, essentially cash. The U.S. aggregate, the bond market, the aggregate market of all bonds in the U.S. The U.S. credit. So this is just corporate bonds, and then we have our corporate high yield thrown in there because we do have some exposure to high yield as well, and some long. We have very little exposure to long-term bonds. We typically don't want to go out that far on interest rate risk, but just to throw that in there. But what you are seeing is exactly logical in what you should see. The T-bills over this period, which is a decent time frame, we're going back to 1998 here, has been a pittance of a return compared to these other bond asset classes, which it should be. There's essentially no risk here. That's great, but there's also not much reward. So as we step out of the duration scale a bit, this is exactly what you're seeing. You're seeing compensation for stepping out on that risk spectrum a bit. And it's exactly why we invest in bonds for the long term. You are looking at consumer price index down here year over year, so CPI. I threw that in there just to show you the comparison of these longer dated bonds outpacing inflation over this period, as compared to cash that has simply not. And that has always historically been the case over a long period of time. Cash simply does not keep pace with inflation, where even bonds, longer duration, have. And stocks handily outpace inflation. So again, just a nice kind of reinforcement for bonds. Fed funds rate. So why would bonds do well in the future? Well, number one, we know that this environment can't persist and that it is kind of turned on its head. Number two, the Federal Reserve is fairly transparent. Granted, I get things can change all the time. They can turn on a dime. But the Fed has been pretty transparent as to their goals and kind of where they see things. And they're projecting, take it for what it's worth, but they are projecting that rates do start to tick down beginning sometime in 24. I'm not predicting that. I have no idea. Things could change next month. But let's just assume that they're trying to follow what their participants kind of foresee in the rate market over the next year to 3. It is clear that they are not striving to keep rates elevated forever. I mean, you've heard the term higher for longer. Sure, they may stay higher for longer, but even a stabilizing rate environment and not a rising rate environment is still going to be good for bonds, simply because they're being able to, the managers have been able to reinvest at these better rates. And if rates, are not continuing to come up, consistently, that's still a much better place that we're going to be, rather than them continuing to tick up. So I realize things could always change here, but it does at least give us a window into their thinking, so you can see where we are now, and then kind of the consensus projection near the end of the year 2023, and then subsequently starting to come down over the next few years, which is a normal rate cycle and to be expected. If you look at the federal funds rate, this is just kind of indicative of this dot plot over here. We're looking at current. This was as of October 2023. So this is a couple days stale. I think it's a couple days stale, but still kind of where we are. So they see obviously a pretty dramatic reduction in the federal funds rate, which follows this well, and so this is what they're seeing longer term, and they're trying to get back down to that more manageable target rate of in that between 2 and 3 percentage points longer term. So a healthy rate. Okay, so now what? So as always, we're continuing to monitor all relevant news and data regarding fixed income rates, inflation, just the markets in general. As always, we are having ongoing conversations with our managers, particularly in the fixed income universe right now. We are evaluating and considering some changes to the fixed income allocations. We will be completely transparent about that, and I will keep you up to speed on all of that. Anything that develops, you will be sure to hear that. So I hope this helps a little bit, and it just at least give you a little color around what's going on and our thought process around fixed income in general. I know that this does not help your returns in fixed income right now. Very aware of that. Nobody wants to move backwards. I fully understand that, and we don't like seeing it either. But know that we are monitoring this, and of course we are all over it. And with any information or changes coming, we will be absolutely upfront and transparent about that. Thank you guys so much. We appreciate you guys more than you know. Really appreciate the continued trust and confidence. And please reach out with any questions. And I'll be back in touch soon on everything we talked about. Here is fun disclosures as always. Other than that, I will talk to you guys soon, and thanks so much, and just have a great day.